Welcome back to the gold standard. Today, gold nearly tagged $4,830 as Iran and Strait of Hormuz headlines hit, then faded as officials stressed the strait is still open.
Yeah, that intraday whiplash was intense. Here's what showed up on the tape. Safe haven bids, a softer dollar, shifting rate odds, and a jump in futures volume all hitting at once.
The important thing to understand is how that kind of panic spike compares with slower forces in the metal space that can matter even more over time.
Exactly. So first, let's think about the gold move. What actually drove price toward 48.30, how options positioning shaped the reversal, and what traders are really reading into war risk right now.
Then we shift to silver, a sixth straight annual deficit, steady stock drawdowns, and what that means for inventories, futures positioning, and physical premiums when the price still looks choppy on your screen.
Think about it this way. Tight silver fundamentals pulling one direction, noisy day-to-day trading pulling the other. So which one should serious investors actually trust?
This leads us to official sector flows, European central banks taking profits, BRICS adding gold, Turkey monetizing, and what repatriation quietly says about trust and custody choices.
Right. And we wrap with the equity angle, streaming names like Wheaton and Triple Flag, plus that new Jervois deal, to ask if you're late to this run or just early in the cycle.
So the key insight here is how to build a metal strategy that links physical, ETFs, and streaming stocks without overreaching on risk.
Stay with us. Let's dig into gold's move toward 48.30 and what the market really priced in this week.
Gold traders have been glued to one thing this week: Iran and the Strait of Hormuz. Headlines hit and gold shot towards that $4,830 area as ships and insurance risks suddenly moved back into focus.
Right, that level got everyone's attention. Let's think about this carefully. What actually happened this week that lit the fuse under gold instead of just being another headline spike?
So first, Iran-linked tensions flared near Hormuz and there were reports of harassment and potential disruptions. That raised the risk that even a partial blockage could choke roughly a fifth of global oil flows, and safe haven bids hit gold quickly as traders priced in energy shock and conflict risk.
And the move was fast. Early in the week, we saw gold jump more than 1% intraday, then fade, then rip higher again. It's like a rubber band snapping with every new alert coming out of the Gulf.
Exactly. Then the second act, officials came out saying the strait remains open, traffic is moving, and back-channel talks might be possible. That cooled the pure panic, so you had this push-pull on the chart, safe haven buying on the spikes, then profit-taking when the "it's still open" headlines crossed.
So here's the key insight. The same news flow that pushes gold up also caps it once traders realize this is risk premium, not a full-blown closure. Does that make sense for framing this week's whiplash?
It does, and to put this in perspective, you can think about three drivers under the hood: the dollar, rate expectations, and volume. The dollar softened a bit as traders priced in a slightly higher chance of rate cuts, which made every geopolitical headline hit gold harder than it would in a strong dollar week.
And here's why that rate piece matters. Fed futures briefly nudged cut odds higher by a few percentage points, yields dipped, and suddenly holding metal looked less expensive versus holding cash. That amplified the safe haven move instead of fighting it.
On volume, cash trading in the major gold ETF and futures both picked up versus last week. You saw a surge during the initial Hormuz scare, then a second smaller burst when talks were mentioned. That pattern tells you this was active positioning, not just sleepy summer trade.
What's interesting is how clean those intraday levels were. Buyers stepping in near prior support, then momentum traders piling on as spot moved through recent highs towards that 4,800 plus area before sellers leaned in hard.
The important thing to understand is that safe haven flows rarely move in a straight line. The first leg is fear. The second is reassessment, once people read past the headline and notice phrases like "shipping lanes remain open" and "diplomatic channels."
So here's my question heading into Monday. Are you watching missiles and tankers, or is the dollar and Fed expectations actually what matters more now?
Both, but in layers. Near term, any report of an actual incident in the strait can push spot higher in a hurry. Under that, I am watching whether the dollar continues to drift lower and whether the market keeps adding to those rate cut odds. Geopolitics sets the sparks, the macro backdrop decides how far the fire spreads.
Here's the connection that matters. Gold can spike hundreds of dollars in a week on fear, but long-term allocation decisions follow the slower grind: real yields, currency trends, central bank demand.
Now let us consider something. If gold can lurch that hard in a week on headline risk, what happens in a metal where the main story is not a flashpoint in a shipping lane, but a shortfall that has been building for years?
So let me ask you this another way. If a few days of tension can shake the yellow metal this much, how should investors think about a market where the pressure comes from a steady supply drain instead of sudden headlines?
Shifting gears, silver is quietly telling a very different story this year. Several groups from Reuters to StoneX are flagging what looks like a sixth straight annual supply deficit in 2026.
Right, and we should define that. When they say deficit, they mean total demand for silver is larger than new mine supply plus recycling for the year.
Exactly. So say the world uses 1.1 billion ounces and recycling. If the world uses 1 billion ounces, the extra 100 million has to come from somewhere.
Which is above ground stocks. Think of vaults, exchange inventories, and private hoards as a savings account. A 1-year deficit is like dipping into savings once. 6 years in a row means that account is getting thinner.
And that thinning is where the word squeeze creeps in. Here's why this matters. People hear deficit and expect price to explode the next day. That's not how it works.
Here's the thing, timing is messy. Look back at silver around 2010 to 2011. We saw tightness in physical bars, speculative futures buying, and prices sprinted higher. The deficit did not cause it by itself, but it was dry tinder.
So for 2026, the real question is, how dry is the tinder now? What data are you actually watching to judge that in plain language?
2 areas. First, inventories. If exchange warehouses report stocks grinding lower month after month, that tells you the savings account is being drawn down. Second, positioning in futures.
By positioning, you mean the paper side. Who's actually long and who's short, yes? Exactly. If the weekly reports show speculators loading up on long contracts while commercial users are heavily short and inventories are already lean, you start to have the ingredients for a squeeze.
Think about it this way. If a lot of traders are promising future silver they haven't secured, and then industrial buyers still need metal, someone eventually has to scramble for real ounces.
Which can show up as rising physical premiums. So if the spot price on the screen is, say, $25, but coin shops and wholesalers are asking $28 or $29, that gap is a signal of tight nearby supply.
Right. Premiums on 1-ounce coins, 100-ounce bars, even some industrial products. When those start climbing faster than the paper price, that's the market saying, I want it in hand.
Now, the important thing to understand is that we already have the fundamental story. Solar, electronics, EVs, and investment demand have outpaced mine growth for several years.
But here's the interesting tension. The price hasn't behaved like a metal in crisis. Silver has rallies, pullbacks, plenty of range trading. So there's a real gap between the narrative and what the chart is actually showing.
And that tension is where strategy lives. Short-term traders are usually focused on momentum, volatility, and key chart levels. They might fade rallies, trade breakouts, or just ride the swings without caring much about a 6-year deficit.
While long-term investors look at that same deficit and say, okay, if above-ground stocks keep shrinking, eventually price probably has to do more work.
Different time horizons, different playbooks. Exactly. So a practical framework could be: traders respect the trend on the screen but stay alert to signs of tightening like falling inventories and rising premiums. Long-term holders use pullbacks to slowly build positions, assuming the structural gap will matter over years, not days.
And both groups need to ask a basic question that gets overlooked. Who's actually supplying that extra silver every year? When the world keeps drawing from stockpiles, someone has to be on the other side.
Which leads straight into the heavyweight players. We talk about retail and ETFs, but official sector flows in gold show us how powerful big balance sheets can be.
Speaking of powerful balance sheets, after the break, we're switching back to gold to look at what central banks are actually doing. Some buying, some selling, some physically moving bars back home. That tells you everything about how they see risk.
I'm just a writer. And once you see how those flows work at the top of the system, it becomes easier to understand why these squeeze stories in silver or gold keep coming back. Shifting gears for a moment, we need to talk about what the big official players are doing with gold right now. On paper, it looks contradictory. Record central bank buying in the last few years, but now pockets of clear selling.
Right, let's think about that split clearly. Who is actually dumping metal and who's still loading up?
Take France as one example. The Banque de France has been trimming around the edges, realizing gains on a portion of its reserves instead of adding. Meanwhile, China has been steadily reporting monthly increases, building a larger gold cushion inside its foreign reserves.
So, same market, totally different playbooks. And then you have Turkey, which is not exactly just buying and holding quietly.
Exactly. Turkey has been monetizing part of its gold stash. In practice, that means taking metal held in reserves and using it to raise hard currency or back domestic programs. So on the data feed, it can look like selling, but the intent is to turn a static pile of gold into something that supports policy.
Here's the thing, and this is important for listeners to understand. France clipping profits, China adding, Turkey mobilizing reserves. What is the actual thread that ties this together?
The important idea is that central banks are treating gold as strategic insurance, not a trading vehicle. Some feel they are overweight and can afford to cash in a sliver. Others, especially in emerging markets, feel underinsured and are still building.
Which brings us to BRICS and the core why behind that buying. Why are they so focused on gold right now?
Think of three big motives. First, de-dollarization worries. Countries like China and Russia want less reliance on the dollar system after years of watching sanctions and asset freezes. Second, diversification. If your reserves are mostly dollars and euros, adding gold is like adding a new asset class that doesn't depend on another country's central bank. Third, pure geopolitical risk. In a world with more tension, holding metal that sits in your own vault feels safer than an IOU from abroad.
And this ties directly into the repatriation story, because the important thing to understand is it's not just how much gold they own, it's where that gold physically sits.
Yes. In recent years, we have seen a clear trend of central banks bringing bars home from storage hubs like London and New York. Repatriation usually means arranging shipment of specific numbered bars that were in foreign vaults back to the domestic central bank's high-security vaults.
So they're not just shifting a line in a database, they're literally moving metal on planes and trucks.
Correct. And that sends a signal. It says, we still trust the international system enough to trade, but we want our core insurance policy inside our own borders.
What does that actually say about trust in the global financial system? Because it sounds like a quiet, calculated vote of caution, and here's why this matters.
I would call it a hedge against future rule changes. If you worry that political fights could spill into payment systems or cross-border custody, then having more of your gold under your own roof feels like prudent risk management.
So let's bring this down to the everyday investor, someone who maybe has a gold ETF or a few coins in a drawer. When they hear about BRICS buying and European selling, what should they actually take from it?
One practical lesson is to think in layers. Central banks treat gold as base layer money, something you hold through cycles, not something you churn based on next quarter's data. That can encourage individuals to see at least part of their gold exposure as long-term insurance rather than a quick trade.
And the split behavior reminds you to ask this question: who is on my side of the trade? If you're selling into weakness while a central bank is quietly buying that dip, you might be handing cheap insurance to a much more patient player.
Exactly. Another takeaway is storage. Central banks are thinking hard about where their metal sits, not just how much they own. That maps to your choice between paper exposure like ETFs, allocated vault storage, or coins in your own safe.
And here's why that choice matters: how you sleep at night. An ETF gives you liquidity and ease. Physical in your possession gives maximum control. Vault storage splits the difference, but adds custodial risk.
This leads us to an important bridge to the equity side. If official buyers are treating gold as strategic, you can also ask which businesses are set up to benefit from long-term demand. In the next segment, we're zooming in on streaming companies, the ones that sit between the vault and the pit. They collect a slice of future gold and silver output, and their cash flows look fundamentally different from a traditional miner.
Keep that central bank image in mind. Careful about custody, focused on long horizons. Then think about how to mirror that same discipline when you're picking mining-related stocks.
With that in mind, here's the sharp question I need to throw at you. Wheaton Precious Metals is up hard over the last year. Is this already late to the party, or is there still a smart way to get in?
The important thing to understand is what you are actually buying with a streamer like Wheaton or Triple Flag. You're not buying a traditional miner that owns the whole mine and all the headaches. You're buying a financing contract on the metal.
So let's think about this simply. What does a streaming deal actually look like in practice?
Think of it like this. A miner needs cash to build or expand a project. The streamer wires, say, a few $100 million up front, and in return locks in the right to buy a slice of future gold or silver production at a fixed low price, often something like 20 to 30% of spot.
Right, so if spot is $2,000 and Wheaton pays $400, they capture that $1,600 spread, minus their overhead. Here's why this matters. That margin is exactly why analysts obsess over these models.
Exactly. And because they do dozens of these across different mines and countries, their risk is spread out. If one mine struggles, it hurts, but it does not sink the whole company the way it might for a single asset miner.
Here's where Wheaton's new deal gets interesting, and this is the kind of thing I track closely. They just agreed to put about $300 million into KGL Resources' Jervois copper project in Australia, in exchange for a gold and silver stream on that operation. So they're piggybacking on a copper mine, but pulling precious metal cash flow.
Exactly. And that tells you a lot about future cash flow and risk. First, the upfront check hits now, but the metal flows later, over years. Second, the economics are tied to two things: whether Jervois gets built and runs well, and where gold and silver prices are during that life.
Which means you're taking on project execution risk, but in a capped way. Your maximum loss is the upfront check, not the endless capital calls that plague traditional miners when costs blow out.
And the upside is leveraged. If silver ends up much higher a decade from now, the cost Wheaton pays per ounce doesn't float up with it. That gap widens and margins expand.
So let me circle back to my opening question. We've got strong share performance. How do you actually decide if you're late or still early with a streamer?
I would break it into two checks. First, is the stock simply tracking metal prices, or has it run way ahead of underlying value? Second, what does the pipeline of new deals like Jervois look like? That pipeline is tomorrow's cash flow.
In other words, and this is the real test, check whether today's price already assumes 10 perfect years ahead, or if the market is still underestimating how many streams they might add, especially on copper projects that quietly throw off gold and silver.
Exactly. And this ties to portfolio design. You do not replace your coins or ETF entirely with streamers. You add them as an equity sleeve that can benefit if metals rise, yet usually has lower operating risk than a classic miner.
Think about it this way. Physical bullion gives you storage of value and tail risk protection. ETFs give you liquidity and simple exposure. Streaming stocks add growth because they can sign new contracts and scale volume even if the metal price just grinds higher instead of spiking.
And the risk profile is different. You are exposed to management decisions, deal quality, and equity volatility. So position sizing matters. For many investors, that may mean a small, single-digit percentage of the overall portfolio, not an all-in bet.
Here's the thing, and this is practical. If you're worried you missed Wheaton's move, one solid step is to build a watch list of a few streamers, Wheaton, Triple Flag, then decide how much exposure you want and stage in over time instead of chasing a spike.
That kind of rule-based approach mirrors what we talked about earlier with central banks: clear objectives, clear sizing, and patience with the cycle. Metal streaming can fit that same disciplined framework if you treat it as a long-term way to tap into the world's demand for gold and silver, not as a quick trade.
And that long view is really the thread through everything today. Bullion flows to deficits to these equity angles. Coming up, we'll tie those threads together into a few simple action points you can actually use.
To wrap up, that Hormuz discussion around gold helps just how one story can tug prices in different directions at once. Safe haven fear on one side and calm reassurances on the other.
There's the story behind the move we were always referring to.
Exactly. That mindset helps you frame gold, silver, and even those streaming stocks as parts of one risk plan, not just isolated trades.
And if that helped you think more clearly about your metals strategy, hit follow on the Gold Standard, leave a quick review, and share this episode with a friend who watches gold every day.
Thank you for spending your time with us. It means a lot.
We'll be back soon with more on where capital is flowing across the metal space.
Until then, stay informed and stay disciplined in how you hold your metals.
We'll talk to you next time.